Despite today's pullback, S&P did manage to end the week higher, nearly 1%, making it the fourth positive week in 5 for the index. But where could it be headed as we move deeper into earnings season? We need a chart. Let's get to Chartmaster Carter Worth, who's looking at the S&P.
Sure, we can look at anything, but thank you. I mean, you know, Grasso, you were making the point that is there any reason, and we can always find one or not, for the market to really press higher here? I don't think there is, right? We're up against the February high, 41.95, February 2nd. But the sequencing is still intact. We have a high of 4 January 2021, and each consecutive high is lower. So the only thing that would be incrementally positive from here, from my point of view, you would need to take out that February 2 high. But the internals, and you guys were talking about that as well, that's the real issue. We have a bifurcated market. And a bifurcated market is when you have real winners, like stocks, right, like the tech sector, like the tele, up more than 20%, while you have others like banks really struggling, consumer. And the thought is that a bifurcated market is resolved by the leaders telling the truth and the weak ones coming to life. It never gets resolved that way. It's the exact opposite. What happens, the weak ones are actually telling the real message, and the ones that are strong are where people are hiding, and those ultimately succumb.
I just want to throw one bullish technical stat at you. It comes from Tom Lee, of course, who's very bullish, of course.
Of course.
But so he says the S&P has now spent more than 25 weeks above the 200-day moving average. Since 1950, there are 0 instances of the S&P doing that, making a new low when it has spent that much time above the 200-day moving average. There
are a lot of these things. I would call it data mining, right? So if you find those, they're typically 20, 40 instances. If we talk to a statistician, typically need about 140 inputs for it to be statistically significant. It's like stock traders almanac stuff. Doesn't mean it might not work, but
you can always
find that. You know, you can massage the data to get anything you want.
But Carter, how about at least just this uptrend off the CPI low? I mean, the October CPI low really is a profound moment for this market, and I feel like this week and even yesterday we gave something back today. We got back above that trend line, which was wounded by SVB.
Sure, and that's fair. One could say that the market has made progress, basically that rates peaked in October, market bottomed, dollar, and we've all sort of found our footing. But at the end of the day, remember, it's just the S&P. If you start looking at other aggregates and other parts of the market, the Russell 2000 is making right now new 52-week relative lows to the S&P. The consumer, the XRT, the equal-weighted consumer, is literally hovering. Ford, GM, stocks that are just not progressing. You've got a lot of internals that do not support the, quote, S&P.
The only issue is, and I think, you know, Tim's talking about this too, we've thrown everything negative at this market. We've had a financial crisis, part 2, which wasn't like the first one. We have geopolitical issues. We have China. So everything, too much to go through, and the market just continues to absorb.
But it won't really go up either. So let's actually consider this.
Sounds like a pair of twos.
It might be, right? So if you look at if on a year-to-date performance is arbitrary, right? If it's May, if it's June, right? Okay. But 1 year or 2 year, if you look at equities as a broad thrust, equities are unchanged for 2 years. We had a max gain of about 15%, max loss about 15%, and here we are unch. What is the proposition for real earnings growth or multiple expansion, which is the thing that makes a market go up from here? I just don't see it, and the charts don't really support it.
Well, people think that multiple expansion comes when the Fed cuts, which the market is expecting to happen.
Right, but remember, interest rates are the same level they were in June a year ago. We've been stuck at 3.5.
It's not the level, it's the direction.
I get it, but it always is until it isn't. Listen, when we started the year, and here's the funny thing, we know this, the #1 most loved thing on Jan 1 was banks and financials. Whoops. Guess what was the most hated? Tech. Don't buy tech. Whoops. It's always this way.
Carter, we're going to have to talk a lot more on options action. We'll see you in the next half hour. Thank you very much for that preview.